I'm Matt Bishar with NAREITWeek.com here in New York City for REITweek 2015, NAREIT's Investor Forum. Joining me for this CEO Spotlight is Roger Waesche, President and CEO of Corporate Office Properties Trust. Roger, thanks so much for joining us.
My pleasure.
Now, your company's business is strongly tied to the Washington, D.C. market, and we're hearing sort of mixed news on the strength of the real estate in our nation's capital. What's your take?
Well, Matt, one of the misperceptions about our portfolio is the percentage of our portfolio that is tied to the Washington, D.C. MSA. And the reason for that is our largest concentration of our portfolio is in the so-called Baltimore-Washington corridor. That has a Baltimore orientation. It's part of the Baltimore MSA, and it has economic drivers and demand drivers that are different than Washington. Now, we do have part of our portfolio that is tied to D.C., and that's about 22%. We have about 3% in Washington, D.C. itself, and then 19% in Northern Virginia. Those markets are not as strong or robust as we're seeing in the Baltimore-Washington corridor. So we have 4 properties that are, challenged at this point out of 22. So it's not too bad, and we feel like we're working through them, and we feel like the markets have bottomed in the D.C. region, and now it's a matter of how long the recovery will be before it takes place. Going back to the Baltimore-Washington corridor for a second, which is represents 50% of the company's portfolio. That market is very strong. So occupancy today in the market overall is just about 90%, so only 10% vacant. Supply and demand is, I think, in the favor of the landlord. Concessions are very low, and there is rent growth in that market. So we're very bullish on that market and very fortunate to have it as a big concentration in our company.
And are there any specific subsets of corporate offices portfolio that you're looking to refurbish or potentially replace?
So there's a couple of things there. First, we do have a commitment to make our portfolio that's not part of our strategic tenant niche more urban and infill and amenity rich and transportation rich. So we've been buying or building buildings that are adjacent to metros or in amenity-rich and infill locations. And what we're doing is swapping out buildings that are suburban office buildings in nature. So we're selling those in order to fund an infill strategy. Secondly, we do have about 1 million square feet in our company that we're in the process of redeveloping. Now, half of that, about 500,000 square feet, is buildings that weren't in our portfolio that we got, for instance, a warehouse as part of an office acquisition that we're now going to convert to office. And then there's another 500,000 square feet of property where we love the location. We bought the buildings 20 years ago, very low basis, really like the dirt, but the buildings need to be refurbished at this point. So we will be redeveloping about 500,000 square feet of properties over the next 5 years, and we are very positive on that in terms of upgrading our portfolio.
And lastly, as you look at the next 6 months, what's going to be the biggest challenge for corporate office?
Well, the biggest challenge has been for the last 4 or 5 years, we're tied to the federal government contractor segment. And that segment, there was a budget impasse that ultimately led to sequestration. And as a result of that, the contractor cycle got out of rhythm. And there were a lot of letting of short-term contracts, and so contractors weren't in a position to make longer-term commitments to space. We are starting to see that get back to a more normalized situation now. We do think over the next 12 to 18 months, the contractor cycle will get back to more of a permanent situation where you have longer-term contracts, and as a result, contractors will be able to make longer-term commitments to space. So that's the thing that we're most focused on and believe will drive our business positively over the next 24 months.
Great. Roger, thank you so much for joining us.
Thank you very much.
For more on this and other REIT news and analysis, be sure to visit REIT.com.